Good afternoon, everybody. This is Mark Lynn, and this is the RHC Cost Reporting Year-End Planning webinar by Healthcare Business Specialist on December the 1st, 2022. This is our team at Healthcare Business Specialist. If you need to get a hold of any of us, this is my contact information. Dani Gilbert is my partner, and Dani's contact information is here. Paige Chambers is working with us preparing Medicare cost reports and doing emergency preparedness, and we will soon be having another staff member that's going to be doing Medicare cost reports as well. So we're sort of staffing up in order to handle all of the new and sort of different cost report needs that people have in this new environment that we're living in with the effects of CAA. So we'll go over what that is in a minute. If you've not joined the information exchange group, please do so. That's a good way to keep up with all of the information, any things that change. Like today, they announced the new telehealth rates for 2023 that they actually went down. So that sort of stuff that comes out of MedLearn Matters, we post on there so you can be updated on any types of cost reporting, billing issues, and you can ask questions to the people in the group, and they're very good about answering those questions and giving you some great advice towards that. Disclaimer, everything is current as of today, as far as I know. The session is being recorded. It will be placed on YouTube, and it will be on our website at ruralhealthclinic.com. Also, a link to it will be in our Facebook group. If you do have questions, please feel free to submit them in the questions box. We will have a little bit of time at the end for you guys to ask questions as well. The slides are, the handouts are over in the handouts section as well. Hopefully it will work. These slides, I tend to have a lot of slides, and sometimes GoToWebinar does not like the number of slides I have and will not download it, but it is over there. It's also in the Facebook group at this time, and it is on our website at ruralhealthclinic.com as well. And here's the actual website. It is ruralhealthclinic.com/RHC-webinars, and that's where you will find it. It's the very first one. If you click here, you'll find the presentation for today. The game has changed. It is a much different game for especially independent rural health clinics with the Consolidated Appropriations Act of 2021, where the Medicare upper payment limits, they call it the national statutory limits, have increased dramatically from what it was. If you're a provider-based RHC, then you are now subject to a Medicare upper payment limit that you never were before. That is a specific limit on your clinic. So each one of those limits is different based upon provider, based upon what your cost per visit was in December 31st in 2020. So that's different and new for provider-based. The national statutory limits for RHCs are as follows. You can see they have increased dramatically, and this is from $86.31 all the way up to $190 in 2028. So do remember, when we say all-inclusive rate, it's not really all-inclusive, because that doesn't include laboratory, technical components, CCM, telehealth, hospital services. Those are all billed outside the reimbursement rate, and typically they're billed on a fee-for-service basis. For provider-based, there may be a little different. If you're cost, it's going to be based on cost, but this rate schedule changes things dramatically for our rural health clinics. As we can see here, this orange line is what our cost per visit is using a WIFLE, National Association of Rural Health Clinics benchmarking study. The average cost for a rural health clinic was about $140 a visit in 2020. The Medicare caps, you can see the yellow line goes up dramatically all the way till we get to $190 in 2028. And then it will go up by what's called the Medicare Economic Index, which is usually an increase of 2 to 3% per year. So you can see the yellow line will intersect about in 2025 to where the actual cost per visit, 147, is less than the Medicare cap. So you will not be getting that Medicare cap. You get the lesser of these two numbers. So keep that in mind. Right now, most of you guys will be pretty close to the cap just because your cost per visits are coming at that. I put together just a quick projection to just show you how these numbers work. You only get this $113 for the most part from Medicare Part A, what I call original Medicare. Some, very few of your Medicare Advantage plans will pay you that higher rate. For the first time in my 35-year career, I got a phone call from a Medicare Advantage plan just a few minutes ago asking me for a rate letter for one of our clients wanting to pay them their rate. So it's pretty doggone rare. I mean, I got it once in 35 years of doing this. I've gotten that phone call, and that was today. But let's see here. So Medicare Advantage. So these are your Medicare Advantage plans here. Typically, what I did was I just averaged about 100. I said you get about $105 per visit. For those, I'm using 113 for Medicare Part A, and then for Medicaid, I'm using just an average reimbursement rate of 130. Typically, independent RHCs made their money from Medicaid because that's where it was actually profitable. That's why you became a rural health clinic if you're an independent RHC. And then for commercial plans, again, then these are just estimates. These are ballpark figures, $110 a visit. So you can see, and the reason why I did it this way is because the Medicare, when you fill out your Medicare cost report, we take your total expenses by your total visits. We include Medicare, Medicaid, Medicare Advantage, commercial, self-pay in those visit counts. So your cost per visit in this case was $113 per visit. You actually made money. You were profitable. You made $23,500 in our 2022 projection. Going out to 2028, if your cost per visit was actually the 190, which is the national statutory limit, then you're going to lose money here. You see the number here, you're going to lose $472,000. There's no way you can continue funding a cost per visit at $190 a visit if Medicare Advantage is only paying you $125. Medicaid by then was be paying you $145, and I'm just projecting commercial to pay you $120. So your average payment's going to be $143, and your cost is going to be $190. You would lose a bunch of money. So you're not going to be able to get that statutory limit in the future, probably, unless you're with a hospital system and they can fund you above what you normally would be receiving. It's going to be very hard to keep that rate. So CAA is going to have a huge impact, especially on our cost report, especially how we prepare them. You're going to have to be much more strategic. We're thinking about cost per visit all the time. I've got a scheduled meeting this afternoon to discuss how to keep our rate up. And we're doing a lot more of these interim cost reports, trying to figure out what our cost per visit is running and how to keep that cost up at the end of the year so we don't have to pay back Medicare a bunch of money and hopefully get a bunch of money or some money back from Medicare because of these increased caps. So again, independent RHCs will have a difficult time keeping their cost above the cap. If you're a provider-based RHCs, you do have to watch your cost closely as well because you are now subject to a cap. And if your cost per visit goes way above it, you're not going to get that money. So I've had that phone call a few times from provider-based RHCs that really got hammered because of this. So you've got to watch that. Also, we would expect cost reports to have a lot more scrutiny than they've done in the past. Medicare had a great deal before because Medicare was paying independent RHCs $86 a visit when their cost per visit was about $140. Medicare was actually, making, whether it was that $54 a visit from every independent RHC that their cost per visit was $140 because they were paying $54 less per visit than they should have been. Records of your time, provider time is going to be very important because productivity standards, a lot of you guys didn't meet productivity standards in the past, and we'll talk about what those are in a minute. But it didn't matter because you were so far below the cap that it actually had no reimbursement effect. That's not going to be the case in the future. Same thing for related party transactions. Those did not have effect on RHCs for the most part because, again, you were so far below the cap that it didn't matter. Now, related party transactions will have to be watched very closely and see if they don't have a negative impact on your all-inclusive rate. And counting visits has just gotten more and more complicated. We're not going to go into how to count visits today in this particular session, but that is something that when we prepare cost reports, that's probably the most complex piece of it, and what's allowable expense and what's not allowable based upon how the visits are paid is an ever-changing science that we have to deal with. So let's go into excuse me, preparing the Medicare cost report for 2022. What is it? It's for the Form 222, which is very, very simple. It's probably 10 or 11 pages long. It is for a 12-month period of time. If you're brand new to the RHC program, it's going to be the date that you were surveyed through the end of the fiscal year. I am talking today about 12/31 year end. So if your year end is something different, then just keep that in mind that some of these dates I'm saying may not apply to you. But if you are a 12/31 year end, that's specifically what I'm talking about today. If you are, you can go all the way up to a 13-month cost report. If you were surveyed on December 1st of 2021, you can actually file a cost report from December 21st, 21 through December 31st of 2022. That's a 13-month period of time, and you would just have to file one cost report. So let me see here. I got a question there. Let me see here. Oh, it's David. Okay, where can I find published 2020 AR rates? Okay, we'll answer those questions at the end. Let me see here. Okay, why is the cost report important? Medicare will not pay you if you don't file a cost report. They will actually write you a very nasty letter asking for every penny of money that was paid to you during that fiscal year, and they will stop paying you going forward. So they use the hammer in order for you in order to get these cost reports in from you. Your RHC Medicare rates and Medicaid rates are based upon these cost reports, especially if you're doing what's called a base year cost report, depending on what state you're in. I know Kentucky and Alabama, they have a one-time base year cost report that you do, that your rates will be set based upon that going forward. So if you're in one of those years, you really, really, really have to watch your cost and your cost per visit because you want to try to maximize that as much as possible. You'll also receive settlements for your influenza, your pneumococcal vaccines, COVID vaccines, your monoclonal antibodies. If you're still doing those, you would get that money. Medicare bad debts. If you have a Medicare patient who does not pay their copay or deductible, then you will get 65% of that as well. And the cost report does give you some additional money for copays that you did not collect from preventive services as well. So there's a little bit of money in there for that. Do remember that you are responsible for accurately preparing a cost report as cost report preparers. We're not actually responsible for it, but you guys are. So that's why we have these educational sessions. So we try to keep our class informed about what the rules are, so you know how to comply with those as well. So here's just a listing of the things that you will get on the cost report and the difference between your interim and your final rate. And that could be dramatic because now we're talking about these big increases from, to 113 to 126 to 139. If you get, if you've got 10,000 Medicare visits and, and the $13 per visit swing, I mean, you're talking about over $1 million of change in reimbursement there. So those types of the settlements will be much there's the potential for them to be much higher and pay back much more than you've ever done in the past. Of course, the Medicare bad debts are going to pay you 65% of the allowable bad debt that you put on those cost reports. Your flu and pneumococcal, they're going to pay you for flu about $60 for every influenza shot you give to a Medicare patient. For pneumococcal, it's going to range between probably $250 and $300 for each shot that you do. For providing COVID vaccines, it's typically about $40. You don't have to pay for the COVID vaccines as of now, but you do get an administrative fee for doing that. It typically, it's whatever your cost is, and that usually averages between $25 to $40 per COVID vaccine. And then MABs, they used to run about a couple $100 for every time you did an MAB in a rural health clinic. We don't see that as much since the emergency use for MABs was removed, I think last year. And then, of course, the copays, again, we talked about that as well. Also, if you've got GME, if you've got graduate medical education, you've got a program that you're running residents through, you'll want to keep up with that cost because there is a direct reimbursement for that through the cost report, and there is significant money to be recouped from that as well. For our clients and for you guys, you don't have to be using us to be doing your cost report. This process is pretty much going to be the same for everybody. Number one is we will send out a business associate agreement with you. That's the HIPAA business associate agreement and a cost report agreement, and request a retainer. If you will, if you're using us, if you get it back to us, signed and back to us as soon as possible, that will put you into a drawing. I think we're giving away, Danny, what are we giving away? Is it five $100 cards if we can get it in by December the 15th or something like that?
Yes.
Okay.
Yes. And I will say there are a few agreements that I haven't sent out. So if you need one, shoot me an email and I'll make sure to get it to you ASAP.
Okay. Okay. Yeah. So go ahead and do that. Yeah, we would like to. We're like everybody else. We're trying to collect cash for the end of the year, so we can pay retirement plans and all that sort of stuff too. So please get it to us before December 31st. That would be great. You should receive once we get that from you, we will send you out a cost report checklist, and we will also make sure that your Canopy file is set up. That's what we use. It's a company that where you can upload and we can download information securely for you guys as well. So that will keep you from having to email and do all that sort of stuff with it. Also, you can mail us stuff, you can email it, fax it to us, but again, the preferable way is to use Canopy or use whoever your consultants. Everybody has some type of way to file transfer now. What we would do is prepare your cost report, and then we're going to file it electronically to Medicare. So that's going to be a change from the way that things used to be done in the past. Last year, I think, Danny, what percentage do you think we got done? We filed electronically, 85, 90% maybe?
Yes, that's what I would say, yes.
Yeah, so we've got a lot of you guys already set up to do it electronically. If you haven't got it set up that way, then Danny will tell you about using the system, about how to get that done just in a few minutes here. And if you do electronically, you will receive your tentative settlements much quicker, and your desk reviews will be done almost automatically once we upload those files electronically. Normally, I see those things come back in 2, 3, 4, 5 days. So it's much faster than it used to be that way. So, and we are going to have another webinar that'll go more into details of actual counting visits and some of the weeds of preparing cost reports in January of 2023. So today is just to sort of, what we're trying to do is get you guys thinking about getting your ducks in a row. That's this slide here, because there's a lot of stuff you have to do now in order to maximize your reimbursement on these cost reports. So if you wait until April 15th, to do some things for your tax return. Your tax accountant's going to say there's not a lot we can do for you because the year is over. Same thing with cost reports. If you wait till May 31st and send it to us, there's not a lot we can do to help you get your cost per visit any different than it is. So now we have a little bit of time to do this. There's that Danish proverb, advice after injury is like medicine after death. We're trying to give you guys a little bit of medicine ahead of time so you can do some things before the end of this year, before 12/31. And if you're June 31st, then just change these dates to May 31st. You need to start looking at some of this stuff and trying to get it done by the end of your fiscal year so you can capture this information. So you probably need to have discussions with 3 different people, your tax accountant, so that you can get your taxes in order, make sure you minimize how much money you're paying the IRS, your cost report preparer. This is why we're having this session with you today, so you have an idea of what you're looking for. And then we had a session on Tuesday about PRF funds. So whoever's your PRF granted funds advisor, you'll want to talk to them about how much lost revenue you have to date and how much money you have on hand, because you can use that money to create expenses that will go on your cost report. So you sort of have a plan that you got a lot of ducks, and getting them all in a row to make sure that these things work optimally for you is what you want to do. Because again, your tax accountant may tell you one thing, as a cost report preparer, I may tell you another, and whoever's consulting you on PRF funds say, well, it's just better to do this way. So you sort of have to weigh the advice and the net impact of the advice that you're getting for your particular situation. So it's not easy. Life has gotten a lot more complicated from prior to COVID, when we didn't really have to deal with these PRF funds and all, which is a good thing. And we didn't have to deal with having this super huge cap compared to what it was, which is, again, it's another good thing, but it just causes us to have to make more and more decisions, and the decisions are much more complex than what they were. So give you a to-do list for December. Number 1 is if you have Medicare bad debts, and we'll talk about what those are in a minute, you need to write those off by the end of the year. That's the only way we can claim them on the 2022 cost report. So look through your accounts receivable, look through your Medicare original Part A claims, and go through there. If you've got a $233 deductible and you've tried to collect it from Mark Lynn, and you've sent out 4 statements and you've tried to collect for 120 days, and you're not going to get any money from me because I don't have any, then write that off and put that on the cost report, and you'll get 65% of that. But you've got to write it off out of your system. You have to cease collection efforts. You can't bother me anymore about that $233 after you write it off. So that's something that, in order to get this on the cost report, you have to do. Another thing that you have to do in December is you either spend or use your lost revenues for any unused PRF funds. And it's not specifically cost reporting, but it sort of does work with cost reporting, because a lot of you say, oh, we got all this lost revenue, we're just going to use that because we have $300,000 in the bank, but our lost revenue was $450,000. We're just going to use that $300,000 towards that, and we don't have to write a check or do anything for provider relief funds. And that's true. But what you may want to do is see what your cost per visit's running, and if you did pay out bonuses to your providers or to your people that have worked there for 25 years and have been dealing with COVID, and maybe do a hazard or retention bonus for them, and that would go on your cost report, and that would actually increase your cost per visit and allow you to have a higher cost per visit. So those are some of the things you want to think about there. Typically, you are going to go meet with your tax accountant at the end of every year and go over how much cash is available and how much to bonus, especially if you're a corporation or an S Corp. You'll want to empty that bank account because you don't want to pay double taxes on that money. And it's really going to help us on our cost report to get that money, for you to spend that money and get our cost up as much as possible. Retirement plans too. You got to think about those at the end of the year. If your 401k, you have to fund that by December 31st of this year. Other retirements have different deadlines, so you want to check with your CPA about that. But if you are funding it in 2023 for 2022, you'll need to accrue that expense so we can capture that expense on the cost report as well. So any types of retirement funding that's for 2022 that you actually pay in 2023, we need to know. You need to put it in your books because you need to have much better accrual basis accounting than you did in the past. In the past, we were $50-something less than the cost. We didn't really have to worry about it too much. Now that's not the case. So the world has changed. Also, you might talk to your CPA about your rent. If you have a related party rent, typically that's a building. If you're charging 300 grand for your building in rent and it's been paid for the last 30 years, so you have no depreciation, you have no mortgage, you just basically have $300,000 worth of what they call passive income, that is going to be disallowed on your cost report. And in the past, that didn't hurt you one single bit because we're $54 below the cap. That is going to start biting you in the rear going forward because you are going to be leaving Medicare money on the table for doing that. So what you'll want to do is ask your CPA is, what's our actual cost and what's our actual rent, and can we adjust that rent down in December down to something closer to the actual cost so that we're not losing that additional cost that's allowable on the cost report. So again, these are complex questions that need some talking to. So okay, and then here's the accrual of expenses. These are some of the things you can do. You can actually accrue a bonus to your owners. If you do that, it has to be liquidated or paid within 75 days of your end. So you'll want to think about that if that's necessary as well. If you accrue bonuses or other payments to non-owners, then those can be liquidated within 12 months. So you may want to think about that as a way to increase your cost. One thing I would do is look at your check register in January and February, and if there's any expenses related to December 22, is talk to your accountant and get them to accrue that expense in your QuickBooks or whatever you're using to keep up with things, and put that expense in 2022 because that's going to help us get your cost per visit up as well. We talked about pension plan contributions. Payroll, again, you're going to, depending on when your payroll cycle hits, you need to accrue that payroll that's owed to those people. Maybe you paid payroll on December 25th, but you've got 5 or 6 days that were unpaid payroll. You can accrue that expense on the cost report and in your books, and we will be able to claim that as an expense on the cost report. Accrued vacation and sick pay. You may have people that have, several months of sick pay, or maybe they have 2 weeks vacation that's not being used. You can accrue that expense and put that on the cost report as well. So those are the sort of things that we need to start paying more attention to because of the changes to Medicare. Also, one thing that I should have mentioned this yesterday or on Tuesday in the PRF fund webinar is there is a salary cap in the provider relief funds. It's the executive level 2 limitation for 2022. That number was $203,700. So that's going to really hurt us on our physicians. Some of our nurse practitioners and PAs actually make a little more than that, 203,000. So those, it's not going to help you on the PRF funds for you to bonus out any more than that. So I just wanted to bring that up because that was an oversight on my part. I should have actually put that in there. Cost report deadlines. Here's the specific deadlines that we have. To claim Medicare bad debts, again, 12/31/2022. There's a form that you have to use, which we will show you at the end. Liquidate your accrued bonuses and payments to owners. That has to be done within 75 days of year end. So that's March 16th, 2023 is when that has to be done. For non-owners, it's 12 months. So December 31st, 2023 is when that has to be done. sign up for IDM. We need you to do that. Number one is to make Dani the cost report preparer, or whoever you guys use. That's fine. There's a lot of great cost report preparers that know everything there is to know about cost reporting. That's fine. Make them your cost report, your authorized cost report preparer in MCREF, and have the ability for us to pull what's called the PSNR report, which is what we will need to file the cost report. We'd like for you to get your cost report submission in to us by March 31st. The sooner we get it in, the better cost report we can do for you, the more time we're going to have. And if you think that you need the productivity waiver, or if you think that you're eligible for a low or no utilization cost report, and I'll tell you what that is in a minute. If we can get that in by February the 15th, that would be great. That way we can get these low and no utilization cost reports out the door, and we can go ahead and request your productivity waiver as soon as possible for that. Here is what's called the IDM system, and Dani, here's your slide here, so I'll let you explain what's in here if you don't mind.
Okay. The IDM governs access to the CMS systems by managing the creation of user IDs and passwords. That basically means that end users of all CMS applications will integrate with the solution, and you'll be able to use a single set of logins for the same application. So PayCoast, NPS, or NPPES, the PSNR system, you'll be able to set up a set of credentials and use those same ones no matter which portal you're going into. CMS published a user guide that's 79 pages long. I can send that to you if you want some bedtime reading, or I actually have a 13-slide presentation that I've done where I've condensed everything that's related to cost reporting, and I'm more than happy to send you those slides, and it will walk you through how to set up an account, how to add your cost report preparer to the IDM so that they can pull your PSNR, they can electronically file for you. And the presentation, the slides will walk you through that. And then if you had any questions, I'm more than happy to walk you through as well. Mark, if you want to go to the next one, I think it's the PSNR. Yep. So providers that file cost reports, you're required to register for the PSNR system. And again, that's done through the IDM. Once you do that, you'll be able to obtain the PSNR report, which is a provider statistical and reimbursement report. It basically shows all of your billed claims to Medicare Part A and all of your payments that you've been paid, because all of that goes on worksheet C of the cost report. So your cost report's going to need that in order to file an accurate one, so that you can kind of see what your settlement's going to be before you get it. If they don't have that information, it's more of an estimate, and you're not going to have good numbers to go off of. The PSNR user can order the reports, so you will want that access. Plus, you'll probably want to set up your cost report preparer for that. With that being said, they're going to want to access as a PSNR user. At least for us, I usually get a PSNR user role, and then the MCREF authorized cost report preparer role. So I actually have 2 roles per clinic, so that I can pull your PSNR to prepare the report, and then I can file it electronically once we've completed it. Again, I have a set of slides that goes over all this in more detail, but for the simplicity and trying to save time, because Mark's got a lot more to go over, that's kind of the gist of the IDM and the PSNR stuff that you need to take care of for cost reporting.
Okay. Thank you, Dani. Okay. Let's see here. Okay. The advantage of doing the MCREF is it's much simpler, much faster. Your cost report preparer will love you for doing it this way. It's not a lot of paper anymore. Your cost report gets filed and accepted immediately. We know if there's any issues on that day, so that's really good. They settle up very quickly, so it really is a nice way to do that. And then here again, this is what was different about it, is you have to make Dani or whoever that authorized preparer your Medicare cost report. It's filed electronically, so you don't have to do anything. as far as that goes. We'll send you a copy of it before we file it electronically. You can review it and say it looks good. And once you say it looks good, then he puts a little X in there and it's filed. The Medicaid cost report, depending on what state it is, sometimes we can send those via email. Sometimes, like Mississippi, they have a portal that we have to put it in. But there'll be a different way to do Medicaid than Medicare, depending on which state you're in. You're not going to get the big leather-bound booklet that we used to send out to everybody that has all the stuff in it anymore. That's just gone away just because everything is going to be placed in your client portal. There are 3 types of cost report. There's a no utilization cost report, a low utilization, and a full cost report. And the full cost report is the only one where you fully get reimbursed for things like influenza, pneumococcal, COVID vaccines, bad debts, all those sort of things. You're going to get paid for that. If you have $50,000 more of interim payments, and what I mean by interim payment is if you look at your PSNR and you look at the very bottom line down there where it says interim payments, if that number is $50,000 or more, you have to file a full utilization cost report. If that number is $49,999, you could file a low utilization cost report. All you have to do is send a letter with saying you qualified and a balance sheet and a profit and loss statement and submit. I think we have to print off a little 1-pager identifying the clinic, and that's all there is to it. It's very, very simple, but you don't get all the goodies. You don't get all the extras there. You don't get your interim settlement. You don't get a settlement, which can be good or can be bad. I'll show you that in the next slide. And then a no utilization. If you guys are with pediatric offices and you have no Medicare utilization, then you're probably not listening to this because you don't have to file a Medicare cost report. All you have to do is send in this no utilization cost report. It's extremely simple. It just says we didn't have any Medicare Part A utilization and we don't want any money. And thank you very much, and you're done with it. So these 2 categories here, if you think you're in this, get to us in early January, and we will get those out of the way and get those off of our checklist and get you guys taken care of so you don't have to worry about it anymore. Here is the low utilization threshold here, less than $50,000 in net Medicare payments. So we'll want to, that's where we got that. And here's how you file it. Here's something that I told you all this. The one thing here, the difference in interim rates and final reimbursement rates, there is a little bit of trick to this. I know we've done this before where we've actually prepared the cost report. You've been eligible for a low utilization cost report and your rates dropped down dramatically, and the amount of bad debts and flu and pneumococcal wasn't that much in there, and we actually just went ahead and filed a low utilization cost report so we could keep your rate at $113 instead of dropping it down to $94 a visit. They kept it at $113. You didn't get the flu and pneumococcal, but it saved us like $5,000 or $6,000 of reimbursement, plus it kept our rate at $113. So there are some tricks on these low utilization cost reports that you can use to keep your rate up if your cost per visit is relatively low. So we've had to do that a few times. So again, pull your PSNR report early so we can get started on this as soon as possible. Gathering your information. We have a checklist here. It's about 29 pages. It will be updated for January. We haven't had a chance to quite update it yet. Again, we're mainly focused on trying to get you to do the stuff in December that you had to do today so you don't miss out on any opportunities. And so here's a checklist of stuff that we'll be looking for you guys to pull together in the beginning of next year. Here's the cost report. Again, more on the cost report checklist that we'll be putting together for you as well. The best way to count visits, and this can be a big problem. Now I've got 2 years of cost reports I've got to look through on cost report visits because somebody printed off a computer report broken down by payer. That will typically double count your visits because you have Medicare's primary, Medicaid secondary. That will end up be counting as 2 visits in that particular document. We want you to use a CPT frequency report broken down by provider. So at the end of this year, starting in January, go into your system and make sure it doesn't close out or won't let you do any reports. So pretty much put this on your tickler file for the first week in January, is run these CPT frequency reports broken down provider, not payer. Payer is bad. It's going to overcount your visits. And if you overcount your visits, what's it going to do? Your cost per visit is going to drop it dramatically. So you don't want that. So if you do have, I know we got one client that has like 9 physicians and 1 nurse practitioner. What I always have them do is run the total practice CPT frequency report and then run that 1 nurse practitioner, and then I just subtract the 2, and then that's how I get my number. So if you have a situation like that where you have a lot of physicians and 1 nurse practitioner, or vice versa, if you have a lot of nurse practitioners and 1 physician, you could do it that way and provide that information to us. So it makes it easier for us to count. Visits are important because you do not want to overcount your visits, because again, cost per visit, your cost is up here, your visits are here. If that visit number starts going up, your cost per visit starts plummeting and going down. Most people say, oh, I want to count as many visits as possible because that's good for me. No, it's really bad. So, okay. Allowable compensation, this is important too, especially when you're at the year-end planning. If you guys are a sole proprietor or an LLC, we don't really have to worry about bonusing you out any money or anything like that, because Medicare uses what's called value of services. What that says is, if Mark thinks he's worth $300,000 and I only had enough money to pay myself $100,000 during the year, then I can put on that cost report that I was worth $300,000. And it is allowable on there if it's reasonable. And how we compute reasonableness is we can look at MGMA standards and says, okay, we saw a certain number of visits, and a physician in Tennessee, you know, the average compensation is $80 a visit or $90 a visit. Multiply that number out, and even though we don't have the cash flow to pay that full $300,000, we can make an adjustment on your cost report. We don't have to pay taxes on it. It's a beautiful thing. It's very favorable to our clients. If you're sole proprietor or single member LLC, then you are good to go there. If you're a multi-member LLC and you get a K1, then you're good to go there as well. So keep those in mind. If you're a corporation, you have to actually pay yourself this money. That's when you have to start bonusing out money. And you have to, and we say the same rule for S corporation as well. It's not as clear for S corporation as it is for a regular corporation. I always tell people, just to be safe, try to pay yourself as much salary as you possibly can in an S corporation, because some of these states don't really recognize these Medicare rules. And if you're in a base year, like in Kentucky or Alabama, they may not recognize this value of services. So the little caveat there is, if you're in a base year, you may not want to, you'll want to pay yourself in actual dollars in those situations. So just keep that in mind. And then here's just a summary. Sole proprietor, LLC, you can use value of services. Corporation, sub S, we're telling you, you need to, the comp has to be paid, and you can use what's called a 75-day accrual. There is also something called a notes payable, where you could actually have a note payable and pay it off within 12 months. But you know, I don't like using those because it's sort of in a gray area, but that is something that other consultants will tell you can do, and that is something that's in the Medicare rules. I just personally don't like using it. Okay. And here's the actual rules. So you can see where my reference is here. Value of services rendered by the owner. Such an amount may or may not represent an actual payments made to an owner. I mean, that was, to me, this was very weird when I first saw this. I didn't think Medicare would allow this, but sure enough, it does allow it. And Medicare published this table back in 2014, where it shows here we're in South Central United States, 294,000. Now we have a work paper where we've updated these allowables for physicians up to 2022. So we have that. Nurse practitioner and PA owner compensation allowances are not published, but you can use MGMA. You can use some of the benchmarks that Whitley and the NARHC has published, and those are excellent guidelines for that. Okay, moving on, healthcare provider FTEs. This is something very important, that as far as the amount of time that each one of your providers work, you want to keep up with that, because there's productivity screens. And for a physician, it's 4,200 visits. For a nurse practitioner or PA, it's 2,100 visits, but that's based upon a 40-hour work week. So if your doctor takes off every Wednesday to play golf, if every Thursday they're in the hospital doing medical medical board meetings or something like that, and maybe they're not doing RHC work, then you don't want to count that time in this productivity. So you want to actually, again, it's like visits. You want to keep their hours working as low as possible so that it will lower your productivity standards. So if we do have a physician who's working 40 hours a week, 52 weeks a year, that's going to be 2,080 hours in a work year. We would expect about 17 visits a day, monthly productivity of 350. That's the minimum productivity. Same rules for nurse practitioners and PAs. Now, also, these productivity standards are computed in aggregate. And what that means is Mark, the lazy physician, may only see 1,000 visits a year. Dani, the very super busy nurse practitioner, she may see 7,000 visits a year. And so, or 7,300, no, let's see, how many visits would that be? If I saw 1,000, I need to get to 6,300. So she sees 5,200, 5,300, and I see 1,000. We have met our 6,300 visits. So the cost report computes that in aggregate. So you see how bad I am with math. I'm terrible with math. Okay. So what you want to do is document your productivity or your providers' amount of time seeing patients. Sometimes some people use calendars. Some people use a little physician time study like this where they keep up with your time. What Medicare tells you you're supposed to do, and I've been doing it 35 years. I've seen one person do it right in 35 years, is have one of these for 1 week per month every month for all 12 months. Now, the best I could hope that you guys would do is do this for 1 week every quarter. If you did that, that would be more than 99% of our people do. But do a time study on your physicians, your nurse practitioners, and your PAs, and that would be great. That would be helpful for this. Okay, related party transactions. We talked about this earlier. What this is the physician is on one side of the deal. Maybe his spouse is on the other side of the deal, and she owns the building. We rent the building from the spouse. We pay the spouse, $5,000 a month for rent. What Medicare says is that's not a related party. Those two people sleep together. That's a related party. And so what Medicare says, we're going to throw out that 60 grand that you paid your spouse, and we're going to mark it to what the actual cost was. How much was your depreciation? How much was your interest? How much were your repairs? How much were your property taxes for that building? And that's what we will allow. So we're going to move it down to the actual cost there. And also you can have both sides of the financial interest as well. So maybe you own the corporation and you own the LLC that owns the building. You control both sides of this transaction. That is a related party. So here's why this has an effect now. In 2021, you can see when our cost cap was $100 a visit, we were charging $200,000 in rent, but our actual cost was only 50 grand. We had a little bit of depreciation, property taxes, and maybe a little bit of mortgage interest here. So we actually disallowed $150,000 in the cost report, but it had no effect on us whatsoever. You can see here where it had no effect whatsoever. Moved to 2022, same assumptions, but now our cost per visit has remained the same. We're doing the same exact thing. Our cost per visit is 108. The cap in 2021 was 100. That's why it didn't affect us, because we were above the cap. In 2022, we are below the cap. Our cost per visit didn't meet the 113 per visit. So we actually lost $15,000 worth of Medicare reimbursement from this. So what we did was we revised our rent to where instead of paying 200,000, we only paid 50 grand. Then we lowered that particular not allowable piece by 150 grand. We actually paid ourselves the same amount of money. We just paid it as compensation. Then we actually we actually did not lose that 15,000. That actually put our cost per visit to $120 per visit. The Medicare cap was 113, and that saved us 15 grand in reimbursement there. So keep that in mind as well. Let's see here. COVID vaccines, I got to move quick and we're running out of time. For 2022, you only put original flu, original pneumococcal, original COVID, and original MABs on there. In 2021, it was different. We actually had advantage plans for the first time ever on the flu and on the COVID vaccines and on the MABs, not for 2022. So remember that. And I think I saw a question in there about the Medicare bad debts. Do we include Medicare Advantage in the Medicare bad debts? You do not put those in there. So keep that in mind. Okay. Then here's the logs and the information that you need to keep for COVID and monoclonal injections there, also for your flu and pneumococcal. Same thing that you've done. I mean, most of you got people put patient name, the MBI number, and the date of service on here is what they're looking for. Here's what their flu log looks like as well. Here's what your pneumococcal log looks like. Again, no Medicare Advantage patients in here. I try to keep my Medicare logs clean, where I just put Medicare on one log and then put all other types of shots on another log if you're keeping logs. You don't have to keep separate log. You don't have to keep a log for your commercial insurances or anything like that. You can use your computer system to keep up with that, but you are required to keep Medicare logs and submit those to Medicare for your COVID-19, for your flu, for your pneumococcal. So you'll want to do that. Okay. Capitalization, your Medicare depreciation has to be on a straight line basis using the AHA guidelines. So do send us a depreciation schedule. We will convert that. In the past, we really haven't had to convert many of these because most of you guys were so far, your cost per visit was so far above the cap that it wouldn't affected you one single bit. Nowadays, that's not going to be the case. We are going to have to convert these. So get these to us and we will convert them to a straight line depreciation for you guys. Bad debts. Here's what we're talking about. It's only for deductibles and copays that you see on a remittance advice that you billed on a UBO4. So there's $233 deductible for 2022, and then there's a 20% of charges copay for each patient. So that's what we're talking about. It's just Medicare original is what we're talking about here. So and you have to reasonably try to collect. What they mean by that is make 4 different collection efforts. You don't have to keep all the paper that you send out or a copy of the statements that you send out. As long as your computer system will check that you send out a monthly statement, that should be fine. You have to try to collect for at least 120 days from the date of first bill, and then you have to write it off in the year that you determine it to be. There's no likelihood of recovery, and stop collection efforts at this point. So that's a Medicare bad debt. This is some good news, is that for CCM services, if you don't collect the copay on that GO 511 or the virtual communications at $24 and something one, that you should have a copay for that, then Ralph Sloan from the Centers of Medicare and Medicaid Services has said that we can claim that as a Medicare bad debt. So that's good news. If we've got chronic care management programs, we will be able to get those bad debts claimed as well. So if you got that, look at those and Write those off before the end of the year. This is called a dual eligible or a crossover. Medicare is primary and Medicaid is secondary. And in some states, Medicaid does not pay you the full amount of that charge or that deductible, that copay or that deductible that Medicare says you owe. If that's the case, that difference is an allowable bad debt, and Medicare will reimburse you 65% of that number. So you'll want to do that. You'll want to write it off as an expense, as a Medicare, charge it as a Medicare bad debt expense is the proper accounting for it and what Medicare tells us we're supposed to do. And here's just a summary. 20 copay of 20% of charges, the deductible $233 in 2022. That's what we're looking for from our Medicare patients. You have to build it to Medicare Part A. Nothing else is allowed, not for Medicare Advantage plans, not for commercial insurance, not for self-pay. None of that is when in this Medicare bad debts. You don't have to turn it over to the collection agency, but if you do, you're still trying to collect the money from that patient. So you can't claim it as a bad debt if you turn it over to collection agency. Okay, let's see here. And again, must be written off. We talked about that about 100 times. Must try. Your first bill must be sent out at least 45 to 60 days from date of service. So keep that in mind, as you can't, if you're having billing problems, you need to get your bills out in a timely manner in order to be able to claim this as a Medicare bad debt. Okay, keep moving here. You definitely want to use an Excel spreadsheet. Don't do it on paper. We had to rewrite, I don't know, we took all summer long on that one that we did where they did it on paper and Medicare would not accept it. So you need to use an Excel spreadsheet, submit that to Medicare. Here's Exhibit 2, which is the form that rural health clinics use. Here is the Excel spreadsheets that we use to do this. So if you can just download these, that will help you to do that. There's a bad debt policy for you, a bad debt log, and a Medicare Medicaid crossover bad debt log as well. And then we're getting to the very end here. Settlements. If you do get an interim settlement during the year, let us know so we can put that on the cost report. Whether you got money or whether you paid money, let us know, because that's going to affect your settlement at the end of the year. We have a form in our cost report checklist that says, did you get any of these? That would be great, because right now we don't have a way to look that up unless Danny knows something I don't on that. And here's what it'll look like. It'll say you lump sum payment. This clinic here got $36,000 as a lump sum. If we would not have put that on the cost report, we would have had a big issue of having to pay back that amount of money and more for underreporting. So, and these settlements have been going all over the place. So these interim settlements, sometimes the MACs sort of mess these up and we end up having to pay a bunch of money back. So these are some of the reasons why. I know we're running out of time, so I'm gonna skip through those. Okay, good. So thank you. Let me see here, Danny. I know.
I can read them to you.
Okay, I think.
You ready?
Yeah, I am ready.
Okay. Some of these I answered because they were just one-offs and it wouldn't apply to everybody. Dave asked, it's our experience that your commercial reimbursement is pretty high. I'd say more accurate average reimbursement rate is $80. Is there a way to get credit for the difference of the encounter cost report and the lesser reimbursement that the Advantage plans are paying?
Right now, the answer is no. Now, the federally qualified health centers, FQHCs, do have what's called a wraparound process, to where if a Medicare Advantage patient pays them, and currently the rates for FQHCs like $180 something a visit, maybe close to $190 by now. And so if the Medicare Advantage plan only pays them, $80, then they have a wrap payment that they can get from Medicare. Rural health clinics do not get that. So that is something that we need to lobby for. I know I've talked to Nathan and Sarah has talked about getting that wrap payment in the future. So that's something that we need to add to that. And I'm reading this. Have you found any more about Clover $30 payment from the ACO and how it impact our cost report? Dave, yeah, I did send you an email. And if it's the direct contract payments, the MACs have been considering that to be a part of your payment, and they've been actually reducing settlements by that $30 that you're getting. If it's the same type that, I know Julie Quinn had one that had, and I sent you an email as soon as it happened, David. I was like, oh my goodness, this is not good news. They're considering that to be a part of the Medicare payment. And so you're basically not getting any credit for it if they consider that Clover to be a direct contracting agency, which I think that's what Julie was talking to Nathan and David and I about. So probably what we need to do, Danny, if we can pull a PSNR for David and see if there's a little special line on there that they call it something super weird that you've never seen before. If it's showing up there, David, then we got a problem. Then they're showing it as a payment to you guys. Okay,
Dave, I'll pull that today.
Okay.
And then I think the other one that hasn't been answered is can provider-based RHCs also claim bad debt?
Yeah, yes, absolutely, absolutely. They get the same 65% as they do. So yeah.
Everything else.
Same for, let's see.
Was answered. It was like personal stuff, so I answered those personally.
Okay, all right, good deal. Any IDM, if you guys, do we need to mess with IDM? Okay. Okay. All right, so you got them all answered then?
Yes, sir.
Wow, okay, we only went 1 minute over. That was pretty amazing. I thought it would be worse than that. Okay, everybody, well, thank you for everything. I appreciate it. Danny, thank you for all your help, and we will see you guys very soon, I'm sure. Thank you very much.